Let's stay on the markets, take a look at growth versus value in that debate. Growth has outperformed value in the last decade. Is there a case to be made for investing in value at these levels? Joining us this morning here at Post 9, Research Affiliates founder and chairman of the board, Rob Arnott. Research Affiliates, the only sub-advisor to PIMCO. $130 billion is managed globally using its strategies. It's great to have you in. Thank you.
Wonderful to be here. Thank you.
What did the GDP number and the core PCE print say to you today?
Basically, none of it comes as a surprise. We're in an economy that I think is going to be showing signs of slowing. We have housing. There's no such thing as a recession without a housing slowdown. There's no such thing as a housing slowdown without a recession. They're joined at the hip. And so right now we have a housing market that's severely restrained. If you have a home and a mortgage at 2.5%, you're not going to sell unless you have to. If you want to buy and you're going to have to borrow at 7.5%, you're probably not going to buy because you can't. And so supply and demand are both constrained, which is what allows home prices to remain high. That can falter if there's any sort of move towards equilibrium. And so we've talked in the past about inverted yield curves predicting recessions. I think they cause recessions. And the yield curve inversion set the stage for the housing issues we're facing now.
Right. Have you take any solace in some of the high-frequency data that shows maybe supply is beginning to bottom here?
I take some comfort in that. I also take comfort in the fact that you have 2 job openings for every job seeker. People will say that recessions don't start with a booming economy. That's not true. Recessions always start with an economy that's been booming. It's the nature of the peak and the rolling over. So I view the coming year as one where the bond market is signaling caution. The stock market is shrugging off a lot of that. And in any given year, the normal risk of recession or bear market is about 20%. For the coming year, I'd say it's about 50-50.
So buy bonds. Is that your message?
No. Bonds, I think, are much more attractive than they were at lower yields, obviously. Stocks, I think, are vulnerable. U.S. stocks, specifically U.S. growth stocks. There's a couple of headwinds that play against growth and in favor of value. One of those is relative valuation. When the spread in valuation between growth and value gets enormously wide, any mean reversion will work in your benefit if you're a value investor. Secondly, inflation is good for value relative to growth on 2 counts. Firstly, there's no such thing as high but stable inflation. If you have high inflation, you have elevated market volatility, elevated macroeconomic volatility, elevated uncertainty. Those all work in favor of value because people will start to look for a margin of safety. Margin of safety isn't available in assets where you're buying a future that's 10 or 20 years out. It also plays into value in the sense that higher elevated inflation sustains higher bond yields, and we've seen that play out hugely in the last 18 months. Higher bond yields mean a higher discount rate for long-term future growth, which reduces the value of growth stocks relative to value stocks. The same applies for small versus large. Small stocks are cheap. The same applies to non-U.S. versus U.S. Non-U.S. stocks are cheap relative to U.S. stocks.